Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Thursday everybody. We knew that Hong Kong had a bad 2022, however the official numbers published yesterday showed a performance even worse than already low expectations. According to official government data released on Wednesday, the Special Administrative Region's economy shrank 4.2% year-on-year in the fourth quarter of 2022, marking a fourth consecutive quarter of contraction and seeing a painful 3.5% contraction for the full year versus 2021. This is worse than government forecasts of a 3.2% decline. Commentators are largely in agreement. Quote, overall, the economy was very weak, end quote. Of course, as we have seen, slowing demand, rising interest rates, and a prolonged exit from zero COVID curbs on the mainland and within Hong Kong itself all put pressure on the financial hub. We remember from our episode a few days ago, exports plunged in the territory in December by the most since the 1950s. Increased uncertainty about the openness and freedoms of the territory since the Hong Kong protests and subsequent national security law may also be factors behind the slowdown. Hong Kong has also faced pressure from falling property prices, which declined about 15% last year, with the number of negative equity mortgages in the city hitting an 18-year high. One of the themes that we have seen debated for some time now too is the question of whether Hong Kong can preserve its status as Asia's financial hub, as Singapore, also an ex-British colony, continues to outperform. Hong Kong desperately needs to rebound in 2023. Moody's Analytics forecast Hong Kong's 2023 gross domestic product growth at 4%. However, according to the medium estimate in a Bloomberg survey, Hong Kong's economy is projected to expand about 2.8%. Both would surpass Singapore's projected 2.1%, but to different degrees. However, unlike a relatively healthy Singapore, Hong Kong's economy will need time to get its footing back, assuming that it can. Quote, the recovery isn't fast and strong enough. Overall, some policies need to be adjusted, and we can't press ahead as we did before. End quote. And quote, economic damage for Hong Kong will take time to heal. We currently project that Hong Kong will only exceed pre-pandemic output peaks in 2024. End quote. So while this likely isn't the end of Hong Kong, the territory has a very bumpy road ahead, and Singapore will make sure it has a run for its money. Analysts agree that tourism will play an important wild card for Hong Kong's economic development this year. During the zero COVID years, the sector was savaged. In 2022, Hong Kong recorded less than 1% of the visitor numbers it saw in 2019, an incredible 99% collapse. Gary Ng, senior economist for Natixis, wrote in a note this week that Hong Kong could gain up to $22 billion in annual tourism revenue, about 5.9% of GDP, if mainland China and the Hong Kong Special Administrative Region can see travel normalization. Analysts with Bloomberg Economics write this week too that a tourism rebound should also lift growth this year. Quote, the return of mainland Chinese tourists has brought a glimpse of hope to the tourism and retail sectors, which play a vital role in Hong Kong's recovery. End quote. Indeed, across the bay, at China's other SAR, Macau is already seeing an explosion of revenue from surging visitor numbers from the mainland. The mainland's COVID reopening from the 8th of January, just ahead of Lunar New Year, sparked a surge in travel, with a little over 450,000 visitors arriving in Macau during the week-long holiday, a 300% increase from last year. According to numbers published by the Macau Gaming Inspection and Coordination Bureau yesterday, Wednesday, in January, gross gaming revenue skyrocketed 82.5% year-on-year to $1.4 billion, beating industry estimates of an approximately 35% increase. Gaming revenue is a critical source of government income and central to the economic activity of the Asian casino hub. In 2019, gaming revenue in Macau was 6 times that of Las Vegas. This jump in January will be welcome news, but it comes after 10 consecutive months of devastating double-digit declines. 2022's gaming revenue was the lowest since 2004. Quote, "While the Lunar New Year travel spike was a short-term boon for the sector, it's uncertain whether the sharp pace of gaming revenue growth will be sustained for the rest of the year." End quote. Hey guys, if you enjoyed today's episode, don't forget to hit the like button. Hitting that like button and sharing these episodes is a tremendous help at growing the channel. If you enjoy these sort of videos and you're not subscribed, if you're part of the 50% of viewers who are not subscribed, subscribing and hitting that bell notification is also a massive help for the channel. And of course, anyone who can go that extra mile and help me keep this channel sustainable, be part of the community that allows me to produce these videos every day, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Now, let's continue. Meanwhile, moving back across to Hong Kong, we need to cover one more thing before we move to the next major development. Bloomberg's Hong Kong team reports this week that Hong Kong's wealth fund suffered a record 202.4 billion Hong Kong dollar, 25.8 billion US dollar loss in 2022, hurt by a sell-off in stocks and bonds as interest rates went up, the outlet writes. The fund helps backstop Hong Kong's fixed exchange rate used to defend the currency's peg to the US dollar. Quote, "Looking ahead in 2023, financial markets will continue to face significant uncertainties, and asset prices are expected to remain volatile. The monetary policies of major central banks will continue to dominate the investment outlook, and financial markets will pay close attention to peak policy rates set by major central banks." End quote. Okay, that is Hong Kong. Let's move now to the mainland. China's securities regulator, the China Securities Regulatory Commission, has clarified new industry requirements for initial public offerings on stock exchange main boards. The proposal aims to reform the mainland's $11 trillion stock market, and the regulator is now seeking public feedback on the draft rules until February 16th. Under the draft rules issued on Wednesday, no daily limit on price moves is set for IPO shares during the first 5 trading days. Stocks listed on the main boards are still subject to the 10% daily limit on price changes after this period, however. The draft rules also reiterate that the main responsibilities for reviewing whether a company meets IPO conditions and information disclosure requirements fall on the exchanges themselves. The China Securities Regulatory Commission said that the general mindset for expanding the registration-based IPO system is to, quote, "strengthen oversight while easing controls, to urge market players to perform their duties, and to foster a sound market environment." End quote. Chinese financial media outlet Yicai writes that in addition to the 3 prohibited sectors, industries in the restricted category will include food, home appliances, and pandemic-related firms. Business areas where IPOs will be supported include integrated circuits and advanced biomedical research and development. Bloomberg writes that the change will mean an end to vetting of planned share sales by regulators. It builds on rules adopted by Shanghai's Star Board in 2019, Shenzhen's Chinex Board in 2020, and the Beijing Stock Exchange in 2021, and will shorten review periods and ease domestic listings, adding that the wider adoption of this experimental program, based on US models, was an acknowledgement of the success of the years-long pilot program to let market forces play a bigger role, allying Chinese platforms closer with their global peers. State-run Global Times writes this week that, quote, "the process has been years in the making, and Chinese security regulators have repeatedly vowed to push forward the reform at an appropriate time." End quote, adding that China's ratio of direct financing, especially equity financing, is believed to be too low. Public data dating back to September 2020 show that China's ratio of direct financing is about 29%. In contrast, says the state-run outlet, that of the US is well above 50%. Some commentators believe the new reforms will allow Beijing to promote more capital being poured into projects that align more with national policy priorities. Quote, "These IPO reforms will lead to more listings, and the hope is more capital for firms that contribute to strategic goals like security and self-reliance, self-control in key areas." End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful day wherever you are, and I will see you all tomorrow.